Netflix has just dropped their second quarter earnings, and yes, they beat expectations. But even despite beating, the stock fell over 5%. And while Netflix is without a doubt an amazing company with a strong brand and global reach, in my opinion, this drop might only be the beginning. In this video, I'll walk you through the key numbers from their report, I'll break down what's really going on beneath the surface by analyzing Netflix's financials, and finally, I'll do a quick intrinsic value calculation to show you exactly why I still believe Netflix stock could be overvalued and potentially drop another 50%. So if you're a current investor on Netflix or thinking about buying in, this one's for you. Now, let's jump into the video. So Netflix just dropped another quarter of solid results. Their revenue grew by almost 16%, and they even raised their full-year revenue guidance to as much as $45 billion, which is a bullish signal fueled by foreign exchange gains and healthy subscriber growth. But the real momentum? It's coming from ads. Netflix says its ad business is on track to double this year, and with its new global ad tech stack now live, it's easier than ever for brands to buy ads programmatically. This isn't just extra revenue, it's a high-margin engine. Speaking of margins, they are also moving in the right direction. Netflix now expects a 30% full-year operating margin, up from 29% before. That's largely thanks to higher revenue flowing through while keeping expenses in check. And with major titles like Squid Game, Stranger Things, and a slate of new films dropping in the second half of the year, Netflix is betting big on keeping the viewers hooked. But here's where things get complicated. During the Q&A, Greg Peters, the co-CEO of Netflix, mentioned that despite the content push, engagement per household has barely moved. And in the US, viewing share looks flat. And that is not a thing you would like to see, especially with rising competition from both paid and free streaming services. Additionally, when it comes to live sports, Netflix isn't jumping in just yet. They're staying cautious, focusing on unique events instead of chasing expensive broadcast rights. Still, leadership remains confident. The CFO Spencer Newman pointed out strong fundamentals beneath the FX boost. And Greg Peters said that consumer behavior remains stable even in a tough economy. So overall, a strong quarter with better margins and growing ad business. But serious challenges around engagement, competition, and future content cost. Alright, the earnings look solid. Revenue is up, margins are climbing, but strong quarter results do not always tell the full story. Now it's time to take a closer look under the hood. To do that, let's break down Netflix's core financials to see how healthy the business actually is. Let's check if there are any red flags hiding behind those positive headlines. So as you can see, Netflix is currently trading at around $1,200. And even despite being down more than 5% in the last trading day, the company is still up more than 36% year to date. And over the last year, the company has almost doubled. Netflix is currently trading at over 50 price-to-earnings ratio, with a forward PE of closer to 40, indicating that the company's earnings should improve over this year. They have this amazing return on invested capital of over 30%, which means that the company does a great job at investing their money. Their market cap is around $500 billion and their net debt is only $6, which means that they have fairly low debt, especially for the company that is working in this type of environment. Over the last 10 years, Netflix's revenue more than quadrupled, going from $9 billion to $39. Truly solid growth. Additionally, their operating margins have been improving consistently almost every year, basically showing that they're doing a better job of extracting profits from every dollar they make. Looking at their net income, again, we see beautiful growth over the last 10 years. Finally, this is what surprised me. This is their shares outstanding, and they're not diluting their owners, basically staying flat over the last few years, even buying back shares over the last 3. Now let's see what analysts predict for the company. When it comes to revenue, it seems like analysts predict Netflix's revenue to continue grow solidly over the next 5 years, going from $39 billion to around $67, which according to them is between 10 and 15% annual growth. However, we see it clearly slowing down compared to the numbers we saw before. Now looking at Netflix's net income, the analyst predictions are even better, as they expect Netflix's net income to more than double in the next 5 years. This is mainly due to the operating margin expansion. Analysts predict that their net income will grow at around 15 to 25% over the next 5 years. So from the fundamentals perspective, Netflix is actually in a pretty strong position. They carry low debt, especially comparing to other content-heavy media companies. Their margins are improving, their revenue is still growing, although the growth is clearly slowed down compared to the previous years. And surprisingly, they're not diluting their shareholders. They haven't been issuing new shares, which is a big plus, especially in a market where many companies are constantly expanding their share count. But despite all of that, I see one major concern: their valuation multiples. Even after the recent dip, Netflix still trades at fairly high levels. And with growth slowing and competition heating up, that kind of a premium might be hard to justify. So while the financials are mostly solid, the valuation could be the biggest risk here. And that's exactly what we'll dig into next. So overall, it looks like Netflix is running a solid business. But the real question is, what is it actually worth? Because no matter how strong the fundamentals look, the stock price only makes sense if it's backed by intrinsic value. To figure that out, let's use my intrinsic value calculator to understand if a company could be undervalued today. So over the last 12 months, Netflix did $21.16 in EPS. As we saw, analysts predict the revenue to grow between 10 and 15% over the next 5 years. However, their margins are expanding, and because of that, their profitability is increasing. So let's give them a 20% growth over the next 5 years. And let's say that just like the analysts predict, they will slow down for the 5 years after that, and they will only grow at around 12%. Let's leave the discount rate or expected return at 10%. And for the terminal multiple, I think this kind of growth requires a higher terminal multiple. So let's give them a 20. Now, as you can see, with these fairly positive assumptions, Netflix looks like it could drop another 25% just to be fairly valued for a 10% annual return over the next decade. Now, these numbers are fairly positive, especially in such a competitive market. Because of that, I would like to give them a higher discount rate, just to have more margin of safety. So let's make it 15. Suddenly, it seems like the stock price would need to drop by around 50%. So based on fairly positive numbers with reasonable growth and nothing too pessimistic, Netflix still looks like it would need to drop by around 25% just to be fairly valued. But if we apply a more conservative lens, adding a larger margin of safety, which in my opinion is a good thing to do, especially for a company working in such a competitive environment, those numbers change dramatically. Suddenly, the stock price would need to drop by another 50% to start looking truly interesting. And that doesn't mean that Netflix is a bad business. It just means that the current price is already baking in a lot of the optimism. And in markets like these, overpaying for growth can come back to bite. So where does this all leave us? Netflix has just delivered another solid quarter. Revenue is growing, the margins are improving, the ad business is getting real traction, and they're not taking too much debt or diluting shareholders. That is all impressive. But when we step back and look at the bigger picture, the slowing growth, the engagement plateau, the stiff competition, and most importantly, the stretched valuation, this stock starts looking a bit shaky at its current price. Based on my analysis, even with normal assumptions, Netflix might still need to drop another 25% just to be fairly valued. And if you're aiming for a proper margin of safety, you would be looking at something closer to a 50% discount. Netflix is clearly a great business, but that doesn't mean it's a great investment at today's price. If you're already holding the stock, this might be a good time to reassess your expectations. And if you're thinking about buying in, it could be worth waiting for a better entry point. As always, these are just my thoughts. Do your own research, invest with discipline, and stay patient. Now, if you're looking for better opportunities, I have just released a video with my top 3 picks for July. In my opinion, these 3 picks could outperform the market over the next decade. You should be able to see the video somewhere on the screen or in the description down below. Finally, if you enjoyed the video, consider supporting the channel by clicking the like and subscribe buttons. And as always, guys, thank you for watching, and I hope to see you in the next one. Bye.